G'day, ladies and gentlemen. Welcome to another episode of Expat Chat, episode 146 today. And today we're going to be talking about a very special topic, which does impact a lot of our clients, and it's around equity compensation. We're going to dive into restricted stock units, stock options, ESPPs. I'm sure there's a plenty other acronyms we could throw in there. But before we jump into it, I'm joined with my co-host, Managing Director and Founding Director of the Atlas Wealth Group, Brett Evans. Good morning, Brett. How are you?
Mate, I'm well, thanks. I'm well. It's good to be back on the podcast. It's been a couple of weeks since I've been away, and about to go away again. Actually, obviously,
Um,
Dubai gets heat. Summer holidays. It's everyone flees, and it's the last person in Dubai turn the lights out, sort of thing. So
that's
won't
it,
be the
mate.
last, but now looking forward to getting a breakaway with the family and reintroduce myself as hi, I'm Dad.
So that's why I'd start today being rather professional and formal, just for one
Yeah,
before you go back on leave again.
that's all right. Love it. And then we can get loose after that. So, and the folks who this is their first call, joined by my mate and colleague, James Ridley, who's the managing director for the APAC region and runs the Australian office. So, how's things in your end, mate? I believe it's been pretty cool.
It has been actually. Winter's well into it. It's been very hard trying to get up and go for a ride. And yeah, I mean, we've been really lucky actually the last couple of weeks with just these crisp mornings on the Gold
Yeah,
Coast. These sort of westerlies, southwesterlies come through. I love this time of the year as well. We don't really get winter on the Gold Coast, as we know, but
it gets
it
cool. It
is.
gets cool.
It's a lot crisper, so it's
Yeah.
been good. And not too much else to report. We had the Gold Coast Marathon over the weekend where most of the Gold Coast shuts down. You obviously see plenty of runners coming through. We might have to do it next year, but outside of that, not much to report. We just cleared through the end of the financial year, thankfully.
Yep.
Always seems like a mad dash. Clients finalising strategies for the year, finishing off tax strategies. So that was good. And now hitting the reset button for the new
Yep.
financial year and what that might bring as well.
Yep. And mate, let's get the compliance officers happy in the world. Let's get the jingle, the disclaimer out of the way. All the information we're going to have a chat to you good folks about today should be treated as informational or educational purposes only. Please do not construe this as personal advice. If you do need to get personal advice, please speak to a licensed professional who actually has experience like Atlas.
Absolutely. Too many pretenders out there at the moment coming across as financial advisors, but they're just sales consultants. So be
Exactly.
mindful of what you see out there. But listen, mate, I wanted to talk about an important topic today because based on, I suppose, a lot of new Australians and Australian expats that I've spoken to that have headed over abroad in the last, I would say, 6 to 12 months, a key theme is that equity compensation has been a big portion of their package, their total remuneration package. And when I refer to equity compensation, I'm referring to the fact that they receive shares from their employer or in their employer, I should say. And that makes up, a significant portion of their overall remuneration. And then that's taxed very differently depending on where they are in the world, whether they're still in Australia, they're in the US, they're in Hong Kong or Singapore, or if they're in the Middle East, maybe they're not paying any tax. So I thought, why don't we talk about some of the different forms and types
Yep.
for today's episode?
I think it's a great one, mate. I think, we're seeing more and more companies use these forms of compensation for their staff members, and it's becoming more complicated with the world getting smaller with respect to changes in tax laws and everything. And, the conversation you have with someone in Singapore is very different to someone in the United States. It's different from someone in Dubai versus London. So, mate, let's jump straight into it and give the good folks some good information.
Yeah, absolutely. So I think the most common forms of equity compensation that we see is restricted stock units or RSUs. Now, a lot of the time, you'll sometimes come across, I guess, them being called the golden handcuffs. And the reason for that is maybe when you first sign up and after 12 months that you're working with this employer, you'll get a bunch of RSUs or shares granted to you. And that's normally not the taxing point. That's the grant start date. And then the next sort of part of that is the vesting date. So the vesting date is actually when you finally can do something with them. So the grant date is just saying, hey, listen, here's a batch, here's a parcel. These are going to be on your, I suppose, portal login now. You can see how they're doing. And as long as you don't leave us at this date, these will vest to you. And, vesting can mean a lot of different things. It means you can log in and sell those shares down to cash. And if you're in I guess, a low tax or a tax-free country, great. It's just an extra piece of your compensation. You can go and do what you want with them, but hopefully you're making some smart financial decisions with that extra cash, because often it is treated as a second income. And in other countries, sometimes a portion of those RSUs or shares will be sold when they vest, because that is the taxing point. And what I mean by that is the taxing point is that, well, let's just do a quick example. Let's say we're residing in the US, my favorite country at the moment. Um, when we're residing in the US, when the RSUs vest to you, if the RSUs total is worth, say, 30,000 or 50,000 US dollars, automatically a portion of those shares will be sold down, because that's going to be the tax that's withheld from that at the vesting date. And then that is sent directly to the IRS. Now, unfortunately, a really common issue comes from that. But the clients or the Australians that are receiving these RSUs aren't aware of it until the tax year is well behind them. Often the withholding tax rate on those RSUs, especially in the US, is usually about 22% at the federal level, and state taxes isn't factored into that. However, their average tax rate might be a bit higher. It might be, say, 30% or 32% or 34% without factoring in any state taxes. So it usually means that when we get to the end of the calendar year or the tax year and they're lodging their US tax return, the accountant is usually saying, hey, listen, we actually owe 30 or 40,000 US dollars in tax because throughout the year you had, say, 100 or $120,000 worth of RSUs vest to you. So that's why it's very important that you have a really good understanding of how your RSUs are taxed, how you need to manage them, and whether you need to look at doing any tax provisioning. And then after that, what you're doing with this excess capital. Are you obviously diversifying it away? Are you putting it into other buckets? But we'll get into that. So that's a quick example of RSUs, restricted stock units. And the tax treatment is different depending on the country that you're in.
And how do RSUs versus stock options versus ESPPs play out? Like, what's a quick understanding that folks can wrap their head around?
Yeah, so I mean, options are a right to purchase those shares, and often there's different types of options, especially in the US, Singapore. But you're given a right to exercise or buy a share at a certain price based on when they're granted to you, and then when they vest, you can actually exercise them. So let's say that I'm 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 given 30,000 options in Nike, and I can exercise the price at say $25, but the stock is trading at, say, $50. Well, there's already a profit there if I was to exercise them straight away. Now, when you exercise those, there's a couple of different methods. There's what's called a cashless exercise, which means you don't have to put any money in to exercise those options, which means that as soon as you exercise them, they'll be sold out immediately, but you just get the profit. You get the
Yep.
difference. You only want to exercise those options if there is a profit. Otherwise, you're making $0. So that's really important. You only exercise shares when they're worth more than the, I suppose, grant price. Often in a lot of countries that obviously aren't tax-free, that profit amount is just treated as ordinary income. So that will go in your tax return, and then you're paying your average or your marginal tax rate on that amount. That is actually quite common, especially in Australia as well. There's different forms of options depending on the country that you live in, and sometimes they can actually be concessionally taxed as well. Depending also on the country they're in, you might have these options. And even when you leave your employer, you still might have a right to them and can still exercise them for up to 10 years. So it's really important that you pay attention to, I guess, the terms and conditions, the T's and C's of your remuneration and your contract, and whether you're given these options and when you can exercise them. We do see some issues, especially with companies that are private and not publicly listed, when you have the option to exercise options, but you don't partake in it. Because you have the option to exercise in it, sometimes that can still form a taxable event in that country, which means you might have to pay tax on that. We saw that actually happen a little bit with, I suppose, Canva.
Mm.
That's one company that happened to, when a lot of staff didn't actually partake in the liquidity event they had. They still had the taxing event, but remember, they can't sell those shares because it's a private company. So That's just a quick example. I don't want to get too nitty gritty in that, but that's
Yeah.
options essentially. Options give you the right to exercise the share. Often the most common that we see is a cashless exercise. So you're just taking away the profit and then you're taxed on that. There are other ways to exercise their shares. Sometimes if you have the cash to buy and exercise the options. So, if the options are worth 100,000 and you actually put in 100,000, but the share price is trading a lot more, then obviously you're making a quick profit, but then you own the shares, you're not selling them down. And then the last one that we talked about and Brett mentioned, it was the ESPPs. So often an employee or employer share purchase plan, I should say, very common in Australia. And it just gives you the right to usually buy shares in the employer company at a discount. And sometimes that discount can range. That can be a 2% discount, that can be a 15% discount. And the most common form is usually your salary sacrificing an amount of 5 to 20% of your salary each month to go into this employee purchase plan. And then you're buying at a discount. And then ideally, you'll just keep accumulating that amount over time and then you'll eventually sell it. But it really, I suppose, helps and attract staff and employees to have buy-in in the company, especially if they are aligned with the philosophy. But we often see a lot of mismanagement around equity compensation.
Yeah, I think people have a jaded view or they don't pay attention to the specific phraseology and they assume one thing, it's actually the other. So you always get that confusion out there. And then it's like, okay, I've got my head around RSUs. I'm moving from this country to this country. Oh, it's a completely different kettle of fish. So,
Yeah, that's
and
right.
I think you'd agree the timing with these sort of things is imperative. Where you are,
Oh,
what time these things happen can make a huge difference.
absolutely. No question at all. And I mean, we often see, I suppose, clients and I suppose new expats that have just left, not paying attention to vesting schedules or the tax implications, but then when they should be selling down, there might be an emotional attachment, a fear of missing out, or usually it sends us back to like a lack of education or knowledge of how to manage them.
Yep. No, I totally agree, mate. But look, to me, I think the biggest thing that, both of us see is that concentration risk. If you're working for a company for a good sort of 5 or 10 years, it's very easy to build up both in shares and options and RSUs quite a sizable tilt of your financial affairs towards one company, one sector, one geography sometimes.
Yeah.
I think managing that's the hardest thing because it comes back to your point of, sort of, yeah, that emotional attachment. I work for Tesla. Yeah, Tesla's the best company in the world. I want to back Tesla. But I think the hardest bit is getting over that sort of, yeah, something you put on yourself in terms of if I sell Tesla, it means I'm not a team player. No, all you're doing is you're preparing for a graduated departure in the future point of time, but also just locking in some good gains. Obviously, a lot of these sort of compensation schedules are driven around tech stocks, especially,
Yeah.
and you never make a profit until you sell. The amount of times I've seen clients who have this large amount of wealth created very quickly and then something happens to the company or the market, it all comes back down again. If they just took a bit of skin out of the game, along the way, they're not so overly exposed.
No, that's right. And I think we always see a lot of biases, psychological biases when maybe clients have held these for, or I suppose Aussies, anyone really, have held these kind of equity compensation for maybe a few years and the shares have done really, really well. So you're like, oh, they'll keep doing really, really well. And then there's a bit of a market pullback. And unfortunately, tech is a very sensitive sector. So when it does pull back, it usually pulls back pretty hard. We've seen a lot of those tech stocks over in the US, capitulate by more than 50 to 60 or even 80% of their share price and they're still struggling to get back up there. So there's a lot of overconfidence that builds and then anchoring as well. Oh no, I don't want to sell. I'm waiting for it to get back up to 755 US dollars per share. It's like, okay, well that might not happen for 15, 20 years now
Yep.
based on how the company is performing. We need to diversify, we need to form a plan and we need to make sure we're still building wealth in a tax efficient manner rather than having this overconfidence and I suppose having this inertia to let go, where if we just followed a bit of a sensible plan, bit of dollar cost averaging, we'd be a lot further ahead on our wealth journey rather than just putting all our eggs in one basket. Because then, as you said, there's that concentration risk. You're now dealing with systematic as well as unsystematic risk technically as well. And then there can also be some tax traps along the way by just being exposed to one share and this blowing out capital gains event that's eventually going to happen. So that's a really important one.
I think
Really, I
also
guess
too,
important.
so I was just going to add one point there. I think it was an important point that people really miss. Your job slash salary is one of your largest assets. So if you look at your annual salary, not talking about RSUs and that sort of stuff, just your average salary, times it by 10. That is the perceived rate of return that you have to invest that capital amount. So if you earn $100,000 a year, times by 10, that's $1 million. Your job is actually, as an asset, is worth $1 million. You have to go out and put $1 million into something that will give you that rate of return of 10%, which is quite high. Some people would use a factor of 20. So when you're looking at your wealth and you see these RSUs and the ESOPs and all these things, factor in your salary as an asset as well too, because that will give you a true understanding of your concentration risk towards that one particular company.
Oh, absolutely. No question at all. I've had clients where their salary or their total compensation's been slashed by more than 50% because the share price has dropped that much. So
Yep.
I don't know too many people that are showing up to a job where they've just taken a pay cut of 50% the next day. So it does happen though. And that's obviously the risk there. So we need to zoom out and go, okay, well, what's the best way to manage these? And
Yep.
it is diversifying them, diversifying away from just being exposed to one stock. And often it does come down to, these vesting schedules. When you look at them, a lot of the time they are either annually, semi-annual or quarterly. They are
Yep.
the most common that I've come across. And if we are selling when it vests, it means we've, ideally had a bit of tax come out of that, set aside a bit of cash for the tax payable that would be coming, especially for those that are probably in the US. And then now we diversify. We spread that asset or those proceeds into either a diversified, I would say, portfolio. You consider your retirement accounts, superannuation. You look at paying down debt. You look at investing, or taking on more debt. There's a lot of different avenues that you can diversify rather than just having it all in one stock. So I think selling as you vest can be a really sensible strategy, but it always seek advice as to whether it's the right strategy for you. But diversification is definitely a key one. So systematic selling to reduce the exposure. I think being tax aware when you're diversifying as well. So different countries have different capital gains tax concessions and allowances. So if you're uninformed about the kind of tax or the kind of concessions that you can access by selling down now versus holding, then you do need to reach out to a professional, a specialist, have the conversation, engage for advice, go, I've got all these RSUs which are vesting or they've already vested. I don't know how to manage them. It's a really common story. So, you plan accordingly. It could be the difference of you retiring sooner rather than later.
Yeah, look, correct information is powerful. You can make informed decisions. You can be very prescriptive. You can execute with conviction. That's the thing we talk about clients all the time. When you understand the moving parts, do this now, do this. You're optimizing everything. Yes, taxes are, a function of life now. But if you can optimize that tax scenario, we'd rather see more money in clients' pockets than, the federal authorities.
Oh, absolutely. And I think when we think about everything going on right now in the world, a lot of the geopolitical risk, how the US dollar is tracking at the moment seems to be getting weaker, especially the last 7 months. You look on any, I suppose, DXY chart or even the Australian dollar, the US dollar, there's just this key theme. The US dollar is just getting weaker and just getting weaker. But with that in mind, it also means, if you're holding all your wealth in this one stock and the US dollar is getting weaker, then your wealth
You're
is
getting
technically
weaker.
going backwards as well. Exactly right. So diversify where possible. If you're not sure how to tackle it, reach out to a professional so you're not going to blow up your overall wealth and have a big tax event rather than managing it, on a dollar cost averaging strategy when it vests accordingly.
I think that's spot on, mate. I think just having that chat, it never hurts. But once you understand your options, yeah, it's like colors. Everyone's got different favorite colors. Same thing with managing your wealth. People have pot committed, where to go and all in. This company is going to the moon. Let's go. Yeah, that's only probably 5% of people. The other 95%, they're like, oh, it's getting a bit high. What do I do? What do I do? They know
Mhm.
deep down that they've done well. How do I maximize that and don't make myself so exposed? So definitely, folks on the call, yeah, have a look at your equity compensation. Have a look at those statements that you never look at. Quite often employers have portal logins. Go in there, look at your vesting schedule. These are stuff that's not exciting, but it is summer for those in the Northern Hemisphere, which is the majority of us.
Mhm.
Things tend to be a bit quiet. Use this as an opportunity to go through and look at everything. By doing that, you might find, I've had a client 12 months ago. We found $500,000 in unvested options that she hadn't exercised. She didn't even know if she had. And right there and then she did it, and she just put 585,000 US dollars in her account that she did not know she had. So
Remarkable.
yeah, it is. It is. And that's the thing. It's unless you look, you're not going to know.
No, absolutely, mate. And a quick shout out to our Facebook group as well. Australian Expat Financial Forum, some great things going on in there. If you're not in there, please feel free to join. If you've got any questions that you're trying to tackle, what we love to see is that community growing each week, and a lot of Australians asking questions and a lot of other Australians answering because they've already solved it. It's great to see someone that's got an issue that's over in, say, Italy, has a similar issue as someone that might have in the US. And it's not usually around tax, it's just around managing their finances, currency transfers, or coming back to Australia, whatever it might be. Jump in there, pose your question if you have any, and we'll jump into it as well. And if it's not answered in the group, we will certainly jump on it and answer it on the podcast, because we love doing those Q&A sessions as well. And then lastly, keep an eye out on the socials. We've got another webinar coming up at the end of this month. It is surrounding US and US tax, managing your finances. More importantly, that big, beautiful bill is passed and it's going through. So we're going to get a US tax accountant on and do a bit of an update on what that means for those dual nationals in Australia, as well as Aussies that are in the US as well.
Love it. Love it. More information, more information, more information. So, mate, let's let these folks start their work day, finish on the treadmill, finish walking the dog, or whatever they're doing when they're listening to this. Thank you, James, and we'll catch you on the next episode.
Sounds good. See you guys.
Cheers. Thanks, mate.